Craig, give us a summary of what the heck is going on with bonds and when do we get a relief bounce?
Yeah. So we've been talking for a couple months here since the end of July, early August, when Treasury announced the increase in the debt supply that was going to be coming in both the third quarter, but specifically in the fourth quarter on accelerating fiscal deficits and the issues there. And we kind of pointed out that this was going to be a supply-demand imbalance that was going to be hard to deal with for Treasury.
This episode is presented by EDGE. EDGE is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDucTrading founder, Samantha LaDuc. Sign up for EDGE today and take 50% off your first month. Enter promo code at checkout. For more information about EDGE, visit www.LaDucTrading.com/edge.
Yields have been moving materially higher kind of since that end of July, early August date. Term premiums have gone from reasonably negative to positive in the bond market. So fixed income investors are running for the hills, and really it's driven by this concept of supply demand. So we have accelerating Treasury issuance, and on the demand side we have less buyers, right? We don't have the Fed buying. We have the Fed actually engaging in QT. So they're really more of a seller than a buyer. We have foreign demand has been slowing, and so that really only leaves kind of retail demand, which is more price sensitive. And so we're seeing continuation of yields moving higher. And with respect to the Fed, these moves in the bond markets accelerated further after the Fed meeting. And we had talked about, I think, on this last time, was an expectation at the Fed meeting to remove cuts from the forecast in the SEP, as the Fed was going to upgrade their assessment of the economy. And that's exactly what happened. We went from 4 cuts for 2024 to 2 cuts, and another kind of frying pan moment for markets, which realized that the Fed was not going to be rapidly returning to a liquidity enhancing regime. The Fed is concerned about sticky inflation. They are still desirous of a soft landing, golden path where they could bring down inflation without disrupting the bond market. But under really no instance are they thinking about adding liquidity. And so I think the collective psyche of fixed income investors is really realizing these supply demand dynamics that are in play. And so we're seeing, a very sizable backup in long end yields. Curves are beginning to uninvert and in some cases steepen out as long-term yields are moving higher. And we are starting to see some cracks as the impact of these higher yields hits various parts of the global economy and global markets. And so I think that's what the market is wrestling with collectively now. And, whether it's in Japan, whether it's in Europe, whether it's in the UK, all these developed market bond yields are moving back, very close to the highs again, as inflation again remains sticky. And, the global selling of fixed income exacerbates, around the world. So it's precarious here, and the impact on U.S. equities, which I know is a focus for everybody in this room, I think has been playing out to a large degree. And I know you don't see it, really aren't impacting equities. They are impacting equities. The most levered securities in the markets are performing horribly. I think I saw the net leverage factor is down 15%, in the last 6 weeks. Banks are starting to perform pretty poorly. I mentioned that in my channel this morning. Bank of America making lows, and even some of the the global banks, which we could talk about that as well. And then the underperformance of small caps and IWM. The ratio, I put this in the chat today. Qs versus IWM has made another kind of very strong move to record highs, and the underperformance of small caps, which half of small cap index makes no money and is levered. So the tightening that's coming from will likely succumb to the pressure, and I think we'll break through this 4,200-ish zone, which is seems like a bit of support where the 200-day is, and I think we're going to trade reasonably through that level. in the coming days, weeks, month.
Subscribe to LaDucTrading YouTube channel for more macro to micro power hour videos and other content.